Hey, Jeffrey here, and this is the second part of my weekend market update. I call the first one topping as a process. As I mentioned, I would come back quickly and look at which pick I'm going to work up for an option selection, where I'm going to put my stops and my targets, and we'll talk about that now. Again, my email address is marketmripro@gmail.com. Google Group Top Down Trader, and the website launch later this week will be at marketmripro.com. Very excited about that. This is for educational purposes only. Anything I talk about should be taken in the spirit of education, not investment advice. I am a doctor, not a financial advisor. I have none of the licenses or permissions that would allow me to tell you what to do. You alone are solely responsible for any decisions you make. I may own or intend to buy or sell anything I mentioned. Trading stocks and options should be considered risky. You should always consult with your financial advisor before making trades. And I've got tools in multiple platforms, and I like using my Market MRI app for these teaching sessions. The wealth chart video will come out Monday morning. And just to remind you, I'd love to have more people come live. Right now, the room's going to be fairly empty. I got a bunch of people online. And love to have the room have a few more people in it. It's October 26th and 27th, 2 days education. Marriott Palm Beach Gardens, 1250 includes all your meals for the days you're there, including a dinner Sunday night. Hotels 155 a night. It's 15-minute Uber from the airport at Palm Beach International. If you want to have double your fun, you come in on Thursday and you go to John Person's seminar, separate fee on Friday and Saturday, and then mine for Sunday and Monday. Anybody that attends will also get a $400 rebate towards any of my tools. And once you register and pay, that triggers the rebate that you can use before the meeting if you wanted to look at my TradeStation app, my TradingView tools, or my Market MRI Pro app. My Google group is called Top Down Trader. It's easy, it's free, and you get some discounts. All right, so let's go on to the charts. So what I wanted to finish the review with was these are some of my favorite stocks, and you're going to see a lot of pullbacks and uptrends. And JNJ is going to be the winner for workup. But ATI was one that I liked, and let's get that started. Sometimes my data thing goes to sleep. There we go. So here's ATI, and you can see it sold off on a revenue miss, based for a while, and is breaking out here. It's got a John Person buy, taking out the 50, good volume, a CPR volume breakout momentum coming out of a squeeze with relative strength and OBV turning up. I like ATI a lot. BIP, similar pattern with the sell-off, not much of a base, breaking out here. Probably not one I would buy, but what I want to highlight here is it has an 11.2% dividend. And for some people, dividend on a growth stock, hard to believe. Celsius, again, not the one I'm going to take, but one that, frankly, in my regular portfolio, it kind of looks interesting here. I like buying things off of the 50, which Ian used to call free parking. Nice pullback there, clear uptrend, pullback and breaking out over the 50. Datadog, I was tempted to make this display because big uptrend, pulling back here with a clean trend line break, breakout momentum, CPR, coming out of a squeeze. I passed on it because I didn't like its earnings consistency. DRS is Leonardo DRS. It's a defense manufacturer. And again, uptrend, pullback, breaking out after playing with the 50 for a couple of days. Hemrick and Payne, this is an oil services stock, and we're starting to see Halliburton, Schlumberger move. And I think this one had something else I liked. I believe it pays a 5% dividend. Yep. So breaking out after a horrible long downtrend, taking out the 200. J&J, we're going to come back to in a few minutes. This is going to be the one I want to pick this week. And then I really like WCC and WWD, and those I thought would be my workups. You can see I started working this one up. And then I remember sometimes I do this live and I forget to look at options volume. And just trust me, both of them are low volume. And if they're low volume, that means the spreads and the bid and the ask are ridiculous. And God forbid you want to sell them before expiration. It's kind of tough, almost impossible to do. So we're going to look at J&J, and I'm going to talk about which spread I'm going to take and why. So here's your big uptrend on J&J. Sort of a sideways move here, a little bit of a pullback. You had a person signal on Thursday, took out this trend line on Friday. You got a volume and a momentum coming out of a squeeze. Green and white here are the relative strength versus the spider and the OBV. Both look good. So I like to buy high to go higher. So I put a buy stop in. It's supposed to be at like let's see, the high was on that candle was 179.91. So I wanted this to be at like 180 and a nickel. And then I like looking at the last four candles, 1, 2, 3, 4, and putting my stop just below the low of the day. The low of the day on this candle was 174.12, so I think I wanted like 174.05. So 180.05, 174.05, that's a $6 difference. You look at that into $180 stock, that's between 3 and 4%. I call that a tight stop. What I really like is my tight stop captures all the closes going back to this candle here, which was on August 12th. So I would enter an order with Schwab's Thinkorswim platform that says, if J&J trades on Monday above my strike price, or not my strike, but my buy stop of 180.05, enter, and I'll give it the following trade. Immediately, I will put a stop on it. That stop will be what we talked about, below this candle, like 174 and a nickel. Since it's only about 3.5% risk, I'm going to be able to buy a lot of shares or a lot of calls. Let's say I'm willing to risk 10,000 a trade, and let's say that's $4 difference. It's not even. That means I could, well, it's about $4. If I'm willing to risk, say, 10,000 a trade divided by 4, that means I can buy 2,500 shares of a $180 stock. I think I probably wouldn't be buying 2,500 shares of 180 because even though I got a fair amount of money, I think that's a lot of money. However, you get my point. Tighter the stop, the lower the risk, the more I can buy. Sometimes if your stop is too tight, you get stopped out quickly. I think that's a pretty safe stop. Now, I'm not buying shares, I'm going to buy options. So I put this into my favorite options tool. It's called Options Pro. You can buy it through VectorVest, or you can buy it direct. I put in this spread maker, some of the spreads that I like. So I want to review the trades. Let's say I've got unlimited capital and I just want to buy stock. You need to have this thing burnt into the back of your retina. This is the P&L curve of when you buy stock. If the stock price goes up, you get more green, you make more money. If the stock price goes down, you get more red, you lose money. That's it, period. Nothing fancy, nothing else. That's the P&L curve of a stock. You can go infinite upside or you can lose it all. I want to find a trade that costs me a lot less than $17,000 per 100 shares to enter. That limits my downside and gives me unlimited upside. And let's see if we can find one. So here's the ones that I'm going to look at. I am going to look at the obvious choice, which is a long call. The long call gives me an infinite upside. It fixes my downside at the cost of the call, in this case at about $3.50. So for 100 shares, I'm going to have to write a check for $350. What's the max I can lose is $350. Now, that does have a negative impact on me. It means I've got to have the stock move, $3.50 before I get to break even. But once it's moved, then every dollar goes up is a dollar I make times 100 shares. So what's the downside of this trade? There really are very few. You got to pick the direction, which strike price. I'm at the money. Um, what calendar month are you going to go after? And and then how many do you want to buy? Each call is going to get you 100 shares. So if you're just looking at a 100 share transaction, it's $350. Infinite upside, the most you can lose is 350. Now, how is that a risky trade? It's really not. If you can write the check to pay for the trade, that's all you can lose. Now, a lot of people don't think about married puts. What happens in a married put? Here I'm going to buy 100 shares, so I got to have 17,900 and whatever capital. And then I'm going to buy for $3.35. I'm going to buy an at the money put. That means that since the stock is 180 and my put's at 180, if the stock goes up, it's got to clear 335 to pay off the put, and then I keep everything that goes higher than that. But if the stock was to crash, the most I could lose is the $3.35 for the put because I can sell my stock back for $180. Here's the problem with this trade. You make the trade. The expiration date, say it's November, third week in November, Friday. The stock moves to 200. You're sitting with a put at 180. What happens if the stock drops 50 bucks to 150? You're going to get covered between the 180 and the 150. Your put's now worth $30 minus the 335 you paid for it. But those gains that you had that are above the strike price of the put, poof, they're gone. It's not a bad way to enter a trade, especially if you've had a lot of losing trades and you've got bad confidence, because you can't lose this trade except for the $3.35 per share of 100 shares. It's a confidence building trade. I take them when I'm worried about the market. The interesting thing is you look at the P&L curve. It looks just like a call, except the call is a little bit more money. In this case, just a little bit. The call is 350. This is 335. But on the married put, you got to buy the stock. Now, if it's a dividend producing stock like a utility, you buy the married put, protects your downside. You get all the upside and you get to keep the dividends. All right. What about a butterfly? So a traditional butterfly looks like this. You buy one, in this case, we bought one for $170, which is over here. We sold two up here for $180, and then we bought one out here at a 190. So from 170 to 180, you're going to make 10 bucks. But once you start passing 180, you're going to lose up to 10 bucks. Every dollar on the way to 190 is a dollar you lose. Why? Because you get to keep the 10 bucks between 170 and 180, but you're going to lose the 10 bucks between 180 or 90. Imagine that you pick J&J and before expiration this thing's trading at $300 because they just had a new drug come out. You lose everything because once it crosses below the zero line, it's a losing trade. What's the likelihood you're going to get the maximum profits of 562? Zero. I look at this as a horrible trade. You're paying $438. You've got a very limited area of profitability. If you made the right choice and it moves too much, you got nothing left to show for it. I don't like this trade. However, I can change that trade and I can do this. So now I'm going to buy a 170. I'm going to sell two 200s and buy a 110. So I make 30 bucks between 70 and 200. I lose 10 bucks between 200 and 210. That means if the stock goes to 300, I'm going to make 20 bucks. I'm going to make this green area minus the cost of the trade, which is $10. So I can still get a one-to-one return even if it goes way beyond my strike prices. This is a broken wing butterfly. This is my favorite way to enter a trade. Now, I don't like this one because I'm paying $10 to get paid back 20, which means I get to keep 10. I'd rather have a 3-to-1 return. So I'll look at different strike prices and different construction. This is a great way for me to enter trades. I don't like it because it doesn't have the infinite gains. But it also, at $1,000 per 100 shares, it's cost me $10 a share versus paying $179 a share. And yes, my gains are capped, but if the stock moves at all, I'm going to be profitable. So this is a great way, I think, of entering trades, even at earnings time if you want to roll the dice. So this may be my favorite way of entering. And then the last of the bullish positional trades that I look at, there's two. Another one that I sometimes will do is a backs ratio or call ratio backs spread. And here, talk about the construction, and then what we're seeing here is I am going to buy one and sell two. Okay, and so why would I do that? Actually, I'm selling one and buying two. I'm sorry. Why would I do that? I'm selling one and it's going to pay me $3.50. I'm going to buy back two $10 apart for 55 cents. So I am going to actually get paid $239 or $2.39 per trade to take it. So there's no cost. I'm putting it in my pocket. And then what happens between 180 and 190, I am at maximum loss down $10 minus the 239. So the most I can lose on the trade is $7.61. But look what happens. After this point, I am left with a single call with nothing spread against it. And now every dollar the stock moves, I reduce my loss until I get to break even, and then I've got infinite upside. So what's happening here is the two the short call at the money is paying for the whole trade, and it's given me an infinite upside, a area here that I don't want to land in, but I might, and that's where my loss is. And what's really cool is what happens if the stock goes down in price from where I bought it. I'm keeping the 239. So I actually make money if the stock goes down. I keep the premium. There is a period of time where I can lose maximally $7.61 a share. And once I break above this point, which is 197.54, it's got to move a lot, 10%. I have a unhedged call with infinite upside. It's an interesting trade. Learned that one from John Person. And then the last choice is a synthetic. And if I was teaching you and giving you a test and I asked you, what P&L does a synthetic most closely resemble? And I would hope you would look at that and say, but Jeff, that's obvious. That's the same P&L as owning the stock. And I would say, bingo, correct. Now, what's the problem with a synthetic? Our brains. Why are our brains a problem? Because I can control 100 shares with the exact same profit and loss picture as owning the stock, and it only cost me 15 cents per 100 shares. Well, I was willing to list $10,000 here. $10,000 divided by 0.15. Oh my God, let me just see what it is to have that same risk. I could take, let me get it, hold on. CALC, $10,000 divided by 0.15. I could buy 666,000 shares worth of options for $10,000. I'll be a zillionaire. Nah, I might also be bankrupt because it can go to zero just like the stock can. And what gets people in trouble, in my opinion, with this spread is their brains get in the way and they buy too much. I got lucky on an Amazon trade. 40 calls or minus 40 puts at about $400. And the amount of downside risk I had was huge. And to this day, I shudder that I was so stupid. I made a fortune on it because it went the right way, but it was a bad trade because today I would never take that trade. I can't risk this. And what I did wrong was this is nothing wrong with this trade, is the position size was much bigger than it would have been if I bought Amazon stock. But I can fix it. Watch this. What does that look like? Well, Jeff, that's obvious. That's a covered call or a married put. And my answer is nope. It's a synthetic with protection. I'm buying a call at 180. I am selling a put at 180. I have the basic P&L of owning the stock. But then I'm buying a put that's $10 underneath for 69 cents. So I've got to pay for this whole spread 84 cents a share or 800 and or yeah, it's 84 cents for the call. That's it. So 100 times 84. My maximum risk is the $84 that I pay for the spread and the $10 between the 180 put and the 170. So I'm risking 1,084. I have an infinite upside and I'm paying only $84. Now, if we compare that to two things, the married put, um, which would, that's not the one I want this one. Yes. If we compare that to the married put, I had to buy the stock. So I had to pay 17,900 to own the 100 shares, and then I had to pay another $3.35. On the covered call, excuse me, on the naked call that I'm buying long, I had to pay $3.50 a share, or for 100, $3.50. And on this, I used to call the chicken shit synthetic. It's really a synthetic call. I only had to pay 84 cents a share or $84 per call. So they all have similar downsides. Maximum risk 350 on the call, 306 on the married put, 1084 on the spread. The difference is I'm paying 84 bucks to get in, not 350. I like on this trade probably the chicken shit synthetic call, or the broken wing butterfly. And I love broken wing butterflies. I think they're great trades. And the way you construct them is you look at how your thinkorswim constructs a normal butterfly, and you come in here and you edit it, and you'll push this thing out to 200. I'll push that out to 190. So now I have a bull call spread that'll pay me 20 bucks and a bear call spread where the maximum risk is 10 bucks. And I'm going to be left with, there's a $10 range there. It's just hard to see it. And so even if I'm wrong, I still have money, an opportunity. And so my maximum risk is 980.50, which is what it costs to buy. And my maximum profits on this is a little bit more than 10 bucks a share, 1019.50. That's not a bad trade either, but it doesn't have infinite upside. So to me, the win is either the chicken shit synthetic, the married put, or the call. And on that note, I'm going to say goodnight. You want to go through this in slow motion. You want me to hold your hand. You want me to show you exactly what goes through my mind. Come to my live meeting. See you soon. Thanks, everybody, and have a great rest of the weekend.